Well, joining me now on the CNBC Newsline is Bill Baruch. He's president and founder of Blue Line Futures. Bill, good morning to you. You know, obviously, there's a lot of talk about what will happen eventually on the fiscal side. Eamon just ran us through some of the scenarios, or at least where we stand right now. Is all of this necessary? Meaning, is the market counting on some kind of fiscal intervention to the tune of upwards of $2 trillion? And what's priced into the market right now, as we're indicated, a lower open to the tune of about 3%?
I do believe that the market's asking for this, and there's no way to really understand how the market might react. But we can go back to see similar situations, what the market did in 2008, and it did sell off pretty sharply into the rejection by the Senate. There was a little bit of a relief rally, but then the sell-off resumed once they actually passed the bill. So markets like to price things in as quick as they can. Obviously, uncertainty drives fear, and fear drives negative reaction in the market. And I think we're starting to price things into the downside. I think it's likely to get a relief rally, but I think there's a lot of damage out there. Until we see some of the hard data that's going to come out weeks down the road, it's hard to say that there's a bottom end. There's a lot of damage. And last week, I was telling people, too, look at the December 2018 low in the S&P, 2,300. We closed below there. All bets are off, and this thing could really go down to 1,550, 1,700. Now, I'm not calling for 1,550 or 1,700 in the S&P, but I think you need to be prepared to see it.
And so right now, the S&P 500, as you mentioned, sitting just above 2,300. And so that's a key technical level for you. And if we drop below that, that's when you think sort of there could be more fear below?
Actually, the futures are down to 2,200 right now, and I did see a weekly close on Friday below 2,300. So that, I think, is set in motion. That sets this week up. I like to look at those weekly closes. It sets this week up for additional negativity. Obviously, some weakness through the last night and the overnight. And again, we could see a little bit of a relief rally here from into potential passing of a bill. This bill needs to get passed. But obviously, you're also hearing some of the outside numbers of Goldman Sachs talking about a negative 24% GDP in quarter two, 2.25 million jobless claims this week, unemployment above 20%. All of this is very likely, and these are going to be shock numbers. And not only are they shock numbers, it really displays the what's going on in the economy and how the economy is completely shut down. So different than the financial crisis, we're going to be able to restart, and this is going to be that Band-Aid over a massive wound to help get us closer to restarting, whether that be the end of quarter two or the potentially start of quarter three. But obviously, Goldman Sachs does expect a bounce back in quarter three, quarter four. I think that we're going to see the year smooth out much better than some of the scary numbers we're going to see here. But longer term, there is a lot of damage out there. And I guess the fear, too, for those out there with portfolios is, are we going to see a recovery like we did in January of 2019 after that 2018 fallout? And it's hard to anticipate or plan for that to happen. But I would suggest looking and sticking with the names that you like, the names you know, things you use. One of the stocks out there that I like a lot, I use Slack, the symbol work. You're seeing a lot of these collaborative workspaces benefit as well. So those are some things I would keep an eye on.
Got it. It's kind of the Warren Buffett method, right? Use the stocks that you know, things that you feel have long-term fundamental stories intact. Bill Baruch, thank you for joining us this morning.